Good day. As we stand at the threshold of 2025, it's imperative to assess the economic landscape with clarity and foresight. The world is witnessing unprecedented shifts, rising national debts, fluctuating currencies, and evolving market dynamics. In such times, it's crucial to anchor our strategies in principles that have stood the test of time. The remarkable performance of gold at the start of 2025 cannot be understood without examining the broader macroeconomic landscape. The global economy is navigating an intricate mix of challenges: rising national debts, shifting interest rates, fluctuating inflation levels, and geopolitical uncertainties. Each of these factors plays a crucial role in shaping investor behavior and asset performance. When governments continue to accumulate debt at unprecedented levels, concerns about fiscal sustainability and currency stability naturally arise, prompting investors to seek assets that can preserve value over time. At the same time, central banks' monetary policies, including quantitative easing or interest rate adjustments, influence liquidity and investor confidence, further impacting gold's appeal. Inflationary pressures, whether driven by supply chain disruptions, energy price shocks, or labor market constraints, erode the real value of cash and conventional financial instruments, making tangible assets like gold more attractive. Even subtle shifts in global trade dynamics or political stability can ripple through markets, creating opportunities for assets that act as a hedge against uncertainty. Understanding this macroeconomic context allows investors to interpret gold's movements not as isolated events, but as signals within a larger, interconnected financial system, highlighting the importance of awareness, foresight, and strategic planning in wealth management. Financial markets and economies move in cycles, and history has shown that patterns often repeat themselves, even if the timing and scale vary. Periods of excessive debt accumulation, currency devaluation, or economic overheating are frequently followed by market corrections, inflationary pressures, or financial instability. Observing these historical trends allows investors to anticipate potential risks and opportunities rather than reacting purely to short-term events. Gold, in particular, has demonstrated resilience during such periods, often rising in value when fiat currencies weaken or when confidence in traditional financial instruments wavers. By studying previous cycles, one can see how central banks' policies, government spending, and global economic shifts influence asset prices over time. This perspective emphasizes that economic and financial developments are rarely random. They follow patterns shaped by human behavior, incentives, and systemic dynamics. Recognizing these patterns is crucial because it helps investors prepare for downturns, protect their wealth, and position themselves strategically for growth. Ultimately, understanding that history tends to echo itself transforms uncertainty into insight, allowing individuals to navigate markets with informed judgment rather than being blindsided by the repeating waves of economic cycles. Gold has long been recognized as a reliable safe haven asset, particularly during periods of economic uncertainty, market volatility, or geopolitical tension. Unlike fiat currencies, which can be influenced by government policies, inflation, or currency devaluation, gold retains intrinsic value that is universally recognized. When stock markets fluctuate, interest rates rise, or confidence in financial systems wavers, investors often turn to gold as a form of security and stability. Its value is not dependent on any single economy or institution, making it a hedge against systemic risks and financial crises. Moreover, gold has historically maintained purchasing power over decades and even centuries, serving as a store of wealth that transcends borders and generations. This resilience makes it an essential component of a diversified portfolio, particularly in times when other assets are exposed to high risk. Beyond its financial benefits, gold also provides psychological reassurance to investors, offering a tangible sense of security in uncertain times. Recognizing the protective qualities of gold allows individuals to strategically allocate resources, ensuring that part of their wealth is insulated from economic turbulence while remaining positioned for long-term stability and growth. Portfolio diversification is one of the most important principles for managing risk and achieving long-term financial stability. By spreading investments across different asset classes, sectors, and geographies, investors reduce the impact of any single market event on their overall wealth. Gold, as part of a diversified portfolio, plays a unique role because its performance is often uncorrelated with stocks, bonds, or other traditional investments. While equities may decline during economic downturns or recessions, gold has historically maintained or increased in value, providing a counterbalance to portfolio volatility. Diversification is not about avoiding risk entirely, but about managing it intelligently so that no single adverse event can disproportionately affect one's financial position. In practice, allocating a portion of a portfolio to gold, typically around 10–15%, can enhance resilience and offer protection against inflation, currency devaluation, and financial crises. Furthermore, diversification encourages a disciplined approach to investing, preventing emotional decision-making during market turbulence. By combining assets with varying risk and return characteristics, investors create a more robust and adaptable portfolio, capable of weathering both short-term fluctuations and long-term economic cycles while preserving and growing wealth steadily over time. Debt levels and currency dynamics are among the most influential factors shaping financial markets and asset values. When a nation accumulates significant debt, it faces growing obligations to service that debt, which can strain government budgets and create pressure for inflationary policies. Excessive debt often erodes confidence in the national currency, as investors may fear devaluation or reduced purchasing power. Currency fluctuations, in turn, affect international trade, investment flows, and the relative value of assets across borders. Gold stands out in this context because it is not tied to any specific government or currency. When debt rises and confidence in fiat currencies weakens, investors frequently turn to gold as a store of value that is insulated from the effects of monetary expansion or currency depreciation. Additionally, central banks' responses to debt pressures, such as adjusting interest rates or engaging in quantitative easing, can influence liquidity and market sentiment, often amplifying the attractiveness of non-fiat assets. Understanding how debt accumulation and currency behavior interact provides critical insight into why gold performs strongly during periods of economic uncertainty. By monitoring these dynamics, investors can anticipate shifts in market behavior and position themselves to protect wealth while navigating complex financial landscapes. In conclusion, while the path ahead may seem fraught with challenges, it also presents opportunities for those prepared. By adhering to sound principles and making informed decisions, we can navigate these turbulent times effectively, Remember, in the world of investing, foresight and adaptability are paramount.